The final section that we're going to talk about in this class is that stockholders' equity section. If you've noticed, the last few weeks we've talked about assets, liabilities, and then stockholders' equity, or the components of stockholders' equity. We're finishing up with that E portion. Well, we know if we look at our accounting equation, that equity breaks down into two different things: retained earnings and contributed capital. So that's what we're going to focus on in this section. First, we'll talk about contributed capital. This is our external capital. This is money other people have given us, right? Then we'll talk about earned capital. That's that internal capital, retained earnings, the money that we get to keep after we pay dividends that we can invest back into our operations. Finally, we'll learn some more ratios in equity analysis. So contributed capital. Let's remember that corporations offer certain rights. They allow for certain advantages over other forms of business. The most important ones are the right to vote. When you buy a share of stock, you get a right to vote. This includes electing boards of directors. You get a right to receive dividends. That is your expectation, right? As somebody who is purchasing equity, your expectation is that you are going to get dividend revenue. You have a right to share in the distribution of assets. Let's say the company goes bankrupt and they have to liquidate. Part of your expectation is that you get to share in those assets. You are going to try to get your investment back. You also have limited liability. This is why that previous point was so good, is because as an investor, somebody who owns shares, you are only liable up to the amount that you are invested. Okay. You also have the greater ability to raise capital. You have an easier way of transferring ownership. That's selling and buying stocks, right? It's easy for owners to buy, sell, trade shares of ownership in the company. So there are some disadvantages to being a corporation. The first is double taxation. You get taxed once at the corporate level, then you get taxed again at the owner's level. There's more paperwork to do, more regulations to follow. If you're a publicly traded company, then you have to be scrutinized by the SEC every quarter and every year. That's what those 10Ks and 10Qs that we talked about early on in the semester are. Okay. When you file as a corporation, you have to file articles of incorporation. Sometimes these are referred to as a corporate charter, okay, with whatever state it is you wish to incorporate in. Okay. Just because you file articles of incorporation with Delaware doesn't mean that you actually operate in Delaware. You could operate in Texas, but Delaware may have better tax advantages for being a corporation there. They may have easier tax laws. Okay. When you file your articles of incorporation, they have to include the following. Has to be the nature of the firm's business activities. How are we supposed to know if you're taking advantage of gains or losses if you don't tell us what your firm's business is, right? Remember, gains, losses, those are other types of revenues and expenses that occur outside of the business's normal functions, out of their primary operations. Also, the number of shares of stock that you plan to issue, right? How many and the par value. We will call these authorized shares of stock. And then your initial board of directors, always important. Okay, so contributed capital is the amount of money that is paid into the company by owners. It's sometimes called invested capital. It's money that others have given us. It is capital we generated through external means. We sold stocks, we borrowed money, whatever the case is. Well, the borrowing will be under liabilities like we talked about in the last section, but this is external generation. Typically, stocks is what we're talking about here. Okay, so let's talk about the issuance of common stock. Recall that common stock is simply just a representation of your ownership in a company. When you purchase a stock, you are purchasing a unit of ownership in that company, a percentage of that ownership in that company. Okay, we talked about that briefly in one of the other sections where we said, hey, 0 to 20 is insignificant, 21 to 50 is significant, and anything over 50% is controlling. Here we're going to talk about different types of stock. We're going to have authorized, and you're definitely going to want to know these for your exam, okay? So you have authorized stock. Authorized stock is what you put in your articles of incorporation, and it tells you how many do we have available to sell. That's going to be all your issued plus all of your unissued stock, okay? So stock that you've issued and stock that you haven't issued that is just sitting around. Then you have what is called issued stock. These are the shares that are actually sold. Okay, these are sold to whoever, whether that's selling it to an investor, a third party, or that's repurchasing it, right? So it's either outstanding stock that is held by third parties or what we call treasury stock, which is our own stock that we have repurchased. You have outstanding, like I said, this is shares issued and held by investors. The investors actually have this in their hands. And then you have treasury stock, which are shares issued and then repurchased by us. You're going to want to know the differences between all of those, okay? So this pie graph is a good way to look at that. It's a good way to think about this. Authorized stock is going to be the entire pie. Unissued stock is stock that you haven't issued yet, clearly. Then you have outstanding stock, which is stock that's held by third parties. And you have treasury stock, which is stock that we have repurchased. And issued stock is a combination of outstanding stock and treasury stock. When you look at your balance sheet, the stockholders' equity section is now going to look like this. You'll see the number of shares authorized, the number of shares issued, number of shares outstanding, and then the number of treasury stock you have. Here you will notice you do not have an unissued number, and that's because you can back into that by knowing these other numbers. Okay. So let's take a look at an example here. When stock is authorized, we assign it a par value. That par value is the legal capital per share of stock, meaning that is what we get every time we sell the stock. Okay. It typically is the value that the corporation assigns to it. So when they incorporate, they say, we're going to authorize 500 shares of common stock, and we're assigning it a par value of 5. We think people will be happy to pay $5 for this stock. That is par. We say it's worth $5. We can sell it for $5. That's par value. You can also issue what we call no par value stock. Just simply, it's stock that you issue that you haven't assigned a par value to. It's one of those things where you're kind of going to let the market decide what the par value is. Now, when we're talking about stock that's issued that does have a par value assigned to it, there is no relationship to the market value of the stock. Okay, the market value of the stock is going to fluctuate. The par value of the stock will not fluctuate. Once you set the par, it never moves. So, this is a repeat. Sorry, guys. So let's talk about issuance of no par value common stock. So let's say we issue 1,000 shares of no par value common stock at $30 per share. Essentially, we think the market is happy to pay $30 per share of this stock. So what did we get? Well, we got $30,000 in cash. That's the 1,000 times the 30. So $30,000 in cash. Okay. But we also got contributed capital. We're going to add to that contributed capital account by increasing common stock by that $30,000. Okay. So this is no par value common stock. Please make a note that all the proceeds are accounted for directly in the contributed capital into that common stock account. Okay. We don't have this extra account that we're about to talk about when it comes to no par value. So let's assume that they issue 1,000 shares of 1 cent par value common stock for $30 per share. Essentially what's happened is they've sold something that they say is worth a penny for $30. Okay. So what we've got to do is we're going to increase our cash by $30,000 because that's how much cash we got. But we're only going to increase our common stock by the par value, that 1,000 times 1 cent. So we're only going to increase common stock by 10. Now, if we stopped there, right? If we said we have $30,000 in cash, that's a debit to increase, and we have $10 in common stock, that's a credit to increase. We don't balance. Our debits do not equal our credits. So we need an additional credit. That additional credit comes from this account right here called additional paid in capital. The fun thing about this account is it does exactly what it tells you it is doing, which is it houses any capital that's been paid in additionally to what you said the common stock was worth. Okay. So please note that we are using this additional paid in capital account. I will often refer to this just as APIC, APIC, so your APIC account. This is where we record anything received over and above the par value of the stock. Okay, you can kind of think of this almost like a gain. This is our gain on the stock. Now, it's not a revenue, so it doesn't go on the income statement. This stays in the balance sheet. It stays attached to that common stock. Okay, so we got the $30,000 in cash. We have the $10 in common stock. If we stopped here, it doesn't balance. It doesn't look right. So we're going to add that additional paid in capital credit for $29,990.